Good morning. Welcome to today's board meeting. We have one item of discussion for today's meeting, and it's our first conversation related to the 2025 agenda consultation. So an exciting day here at the FASB. We've gotten over 100 comment letter responses from our stakeholders. Lots of other input that we've gotten through other means. And this I would describe as the start of our journey as we consider all of the input we've gotten in public board meetings and make agenda decisions at future meetings. But with that, before I take too many of our team's talking points, let me turn it over to Erica and our agenda consultation team to tee us up this morning. Good morning, Erica.
Great. Thanks, Rich. Good morning, everyone. The purpose, as Rich said, of this morning's meeting is to serve as the kickoff of many discussions that we'll have about feedback that we received on the 2025 Invitation to Comment Agenda Consultation, or ITC, as we'll refer to it today. Today, we'll provide a summary of the feedback received and highlight some of our next steps. A handout for this meeting is posted on the FASB website, and that includes a detailed summary of the feedback that we received. Before we get into the feedback, we first wanted to extend our sincere appreciation to all those stakeholders that sent us a comment letter or participated in our outreach throughout both the fall as well as in the past few months. We received a really significant amount of feedback, but it really included very thoughtful suggestions on what topics that the board should consider and how the board should consider those. So we really appreciate it. We wanted to first start off by providing some perspective of the volume and extent of the feedback that was received and how that feedback will be analyzed after this meeting. The ITC included 42 topics for stakeholders to consider. Stakeholders provided comments on all 42 of those topics and also suggested approximately 30 additional topics for the board to consider. Therefore, feedback was received on over 70 topics for the board's consideration. The extent of feedback received on these topics varied. While feedback on some topics was broad and expansive, feedback on other topics was narrower and more limited. Ultimately, the staff will bring back all of these topics for the board's consideration, as Rich just mentioned, if they would like to add the topic to the agenda, and if so, how it should be addressed. This will be paired with staff analysis on the board's agenda decision criteria and any other research and outreach that the staff has either already started to perform or will be performing to inform the board on those topics. This analysis will come back in a series of meetings starting this quarter and continuing throughout next year. As these topics are scheduled to come back, the staff will communicate with board members throughout the process. Therefore, the board is not being asked today to make any decisions about topics that should or should not be prioritized or how they should be addressed, but rather we're asking the board for any observations they have on the feedback and questions on the next steps, as included in question 1 of the handout. And now Vivian will now briefly go over the demographics of those who responded to the ITC.
Thank you, Erica. As a bit of background on how the content in the ITC was developed, during the second half of 2024, we performed broader outreach efforts with a cross-section of over 200 stakeholders, including investors, practitioners, preparers, academics, and trade groups to identify priority areas for improvements to financial accounting and reporting. Stakeholders acknowledged that the board has made significant progress on the priorities identified in the 2021 agenda consultation. Consequently, many stakeholders noted that they do not think there's a case to make major changes to GAAP at this time. Therefore, the topics included in the ITC were focused on targeted areas for improvements to GAAP, which generally focused on either reducing unnecessary complexity or enhancing information provided to investors. The ITC was issued in January to solicit broad input from stakeholders on the priority of the topics in the ITC and to identify if there were any other topics beyond those in the ITC that should be considered a top priority. 129 responses were received on the ITC. This includes feedback received in comment letters, stakeholder outreach meetings, and advisory group meetings through the end of August. The table in paragraph 6 of the handout provides a breakdown of the composition of the respondents by stakeholder type. The stakeholders represent a variety of industries, such as financial services, pharmaceuticals, oil and gas, energy, and crypto. I'll now pass it to Christina for an overview of the feedback.
Thank you, Vivian. Paragraph 9 of the handout includes a chart that lists all the topics that were in the ITC and what priority stakeholders identified them as. That chart demonstrates both the high volume of feedback that was received and the diversity of that feedback. Since the handout includes details on all the feedback, we won't go through the feedback in detail, but we wanted to highlight some of our overall observations. There was a wide range of perspectives received across topics, and there was also diversity across types of stakeholders. Some topics were consistently identified as top or low priorities by stakeholders, while other topics received more varied responses, with views split between top and low priority. Additionally, even when topics were consistently identified as a top priority, the feedback was often diverse on how the board should address the identified issues. There were differences in views on priority among practitioners, preparers, and investors about which topics the board should address. Investors and investor advocate groups primarily identified topics related to enhancing financial reporting information as a top priority. Practitioners and preparers primarily identified topics related to making targeted improvements to reduce unnecessary cost and complexity in GAAP as a top priority, but had differing opinions on which topics should be prioritized. When it comes to top priorities, stakeholders consistently identified 3 topics. The first was risk management and hedge accounting, then alternative funding arrangements, and the third was interaction of consolidation guidance and other transactions, of which the majority of that feedback focused on business combination and asset acquisition guidance. In terms of low priorities, stakeholders were generally in agreement about certain topics like recognition of interest income and personal financial statements, to name a few. Please see the list in paragraph 12E of the handout for further details. Additionally, there were some topics that received a high volume of feedback, but opinions were split on whether the board should prioritize them, and if so, how the board should address it. For example, topics like enhanced disclosures, distinguishing liabilities from equity, and equity method of accounting received mixed feedback. There are other topics as well, which you can find listed in paragraph 12F of the handout. Lastly, some industries identified specific topics as top priorities like the banking industry identified the accounting for commodities and transfers and servicing. The pharmaceutical industry identified royalty monetization arrangements, which is included in the alternative funding arrangements topic. And the life insurance industry identified long-duration targeted improvements as top priorities, which was not a topic in the ITC issued in January. In the handout, you will find additional details on the specific feedback for each topic. I will now pass it off to Tiffany to discuss the tentative next steps.
Thank you, Christina. Erica touched a bit on next steps during the tee-up just a little bit ago, but I thought I'll summarize those again for everyone. Starting this quarter and continuing throughout 2026, the staff will analyze each of the 70+ topics using the board's agenda prioritization criteria against the feedback received from stakeholders and other outreach or research that may be performed by the staff to help assist the board in that decision-making process. For each topic, the board will be asked to decide if it wants to add it to the technical agenda or if it does not think the topic warrants further consideration at this time. The tentative goal would be to bring back each of the topic for the board's consideration during 2026, and the staff will communicate with the board members throughout the process as they get scheduled. Once the board has completed analyzing the feedback received, a public agenda consultation report will be issued, which will summarize the feedback and how the board considered it. With that, I'll turn it back over to Rich.
Terrific. Thank you. And first off, thanks to our team. I know you spent a lot of time getting through this large volume of feedback, and this is really the first step. Obviously, each of these issues will require further analysis, and we have teams that'll be set up to work on those. Just a couple things for the board. I don't anticipate any resource issues. So when it comes to items that you're interested in working on, if you think they belong on our agenda, we should move forward that way. If we ever got to the point where we had resource or timing issues, I think that would be a discussion we should have as a board at that time. But right now, given where we are on our current technical agenda, I think we have the capacity to address what the board wants to address. And so I think that's an important part. The other thing, and I just want to reiterate what the staff said, is every single one of these issues will come back for a board vote in a future public meeting. So this is by no means your first bite at the apple. I may suggest this is simply showing you the apple. And we'll spend some more time in future meetings getting much more in depth in the understanding and the analysis. So with that, did think it was to give each of you a chance if there's any comments you'd like to make about the input that we've gotten, the great stakeholder responses that we've had, or anything else to give you a chance to share some thoughts. Since you're all going to raise your hands, maybe I'll just pick Fred. Why don't you start?
Well, thank you, Rich. Yeah, first of all, I wanted to thank the staff and the stakeholders who provided the information. I especially like to call out the investors. 33 letters from investors out of this group was a great feedback, I thought, because we often have a hard time getting that kind of feedback from investors. I'd also like to thank the staff for their extensive outreach to investors to get that feedback. In terms of that, it's interesting as we look at potentially 72 projects, if I counted right. Relatively a lot of those are fairly technical and will have limited impact, I believe, on investors. And I think we heard that from investors. However, I think it's important to highlight those that really will have potentially some investor input. And a few things that kind of came to mind in my own mind was that, first of all, enhanced disclosures is interesting because of the controversy, and it was the highest investor priority. But I think that's really something that we have to deal with on a case-by-case basis. I can't imagine that we're going to have an enhanced disclosure project. But I really think it's a case-by-case basis, and I think that's appropriate because when we look at certain industries and certain disclosures, there is an awful lot of disclosures. As a bank analyst, I couldn't get through a lot of it most quarters that was coming out. Conversely, there's other industries where there is not enough disclosure for what investors want to do. And I also want to emphasize that it's really all about effective disclosure. And I think that's what can marry both the investors and the preparers when we look at solutions that maybe there's less disclosure, but maybe there's more effective disclosures and a change in disclosure. So I think that's an important thing. But again, that's going to be on a case-by-case basis. Some other topics I think we heard, and I think it was especially helpful from both investors and all our stakeholders, not only to get topics, but to get prospective solutions. That was especially helpful. I thought, I think statement of cash flows continues to be a top priority. I thought we had very good discussions with the ISB last week on that. I think that broader project is something that we will want to address. AROs, I was very interested in, especially because of some of the proposed ideas on fair value alternatives that could be helpful. Some other areas that investors didn't highlight, but I think can provide a lot of improved information for investors is hedge accounting, because I think there's an area where I think disclosures are, I think I mentioned before, voluminous, but not terribly effective. So I think, and beyond that, clearly, hedge accounting today doesn't reflect the risk management activities of most entities. So I think that could be a big benefit to investors. Distinguishing liabilities from equities, I'm hopeful that there are some solutions that actually could be helpful to investors. It was interesting, I think just reflecting on the goodwill discussion, I thought was interesting because it's clearly not overwhelming support, but I think I would point the staff to the discussion we had with ISB last week that I found very interesting insofar as, preparers would like to look at, an option for immediate expensing. I thought we heard what I didn't really know that is already available in Switzerland. And I think that would be a good case study as we bring back goodwill to look at that, because at least in my discussions, it would be interesting to know what type of industries do choose that option and why, and also investor feedback that at least my anecdotal discussion was somewhat problematic. So I think that's another area that we'll come back to, because obviously whatever we do there would have a big impact on investors. So that's just some observations, and obviously we'll be digging into everything else extensively on a go-forward basis. Thanks.
Right. Great. Thanks, Fred. Full disclosure, I'm going to check off, see if we mention all 72 items in this section. But Joyce?
Thanks, Rich. So first, I also would like to thank the comment letter respondents to the agenda consultation. Many of them not only identify what they viewed as a problem or an opportunity for standard setting, but they explained the rationale and they provided recommendations, in some cases as it related to their sector or their entity or their stakeholder type. And I think that is quite beneficial for our decision making. And certainly I'd like to thank the staff for distilling the comment letter views into this one package, and quite notably performing outreach with those investors who didn't write the comment letters. So that also helped to provide additional information from the user perspective. So I will address research topics that I view are priorities, and I am not going to dissuade the staff from taking on any topic at this time, since clearly research and analysis is necessary before making those decisions. And I'll start with enhanced disclosures. So not surprisingly, investors indicated that disclosures in various areas are a top priority. And I've heard Rich mention, and I now have heard Fred also mention, that perhaps the task at hand may indeed be to address disclosure effectiveness. And when I think about disclosure effectiveness, I view this as an opportunity to enhance relevance and usability of the financial reports broadly. So as the staff potentially considers addressing disclosures, I'd like the staff to consider the characteristics of effective disclosures. In my view, I think that disclosures should connect throughout the financial statements, the entity's accounting policies, and the selection of those policies and the application of those policies with the related balances that are in the financial statements and the composition of those balances. And there should be a connection, I think, to the significant estimates and assumptions that are made around those balances and what might cause those estimates or assumptions to change, and ideally with some sort of likelihood of them changing. And I also think that the disclosure should enable forward-looking analytical capabilities for investors and connect the interrelatedness of the financial statement line items across the primary financial statements. So, and I say this because it seems like many of the comments that the investors made touch on one of those points that I've mentioned. So being mindful of those characteristics as we develop the different types of disclosures in each topic as we go through this process. Now, to be specific in terms of some of the disclosures that investors mentioned that I view as important as well, would relate to intangibles. We talked about this in our board meeting on intangibles, where investors have provided very specific qualitative and quantitative recommendations around IP R&D, R&D costs, acquired and internally generated intangibles. And they're looking to get more in order to bolster their analytical capabilities. I see that as an important area in the disclosure realm. I also see business combinations as another area where the investors are looking for the effects on financial statement line items, as well as other types of disclosures, such as the acquiree's financial statement information and the expected future earnings impact on the business combination for the acquirer. But even broader than disclosures, there are other areas that have disclosure plus matters, whether it's recognition or presentation, and I will address those more broadly. So statement of cash flows is one where investors have had a long-standing call for the cash flow statement improvements. They certainly need to obtain relevant information to assess liquidity. And I think we should consider research on the presentation of the elements that are within the operating and investing and financing activities section. Also, potentially research possible supplemental disclosures of operating activities that relate to the cash transactions. Investors have mentioned, for example, cash paid to suppliers or cash received from customers. In addition, also addressing potential disclosures pertaining to non-cash items as it relates to the cash statement. And quite specifically, we've also heard from investors in this agenda consultation that they are interested in disaggregating cash flow activities into capital growth type investing activities versus maintenance. And we've heard this time and time again, and I think this could be part of that project. And I'm being very specific here because I think it is of importance given the potential of, once again, bolstering investors' analytical capabilities. Moving on to asset retirement obligations, Fred also mentioned it. There was significant interest expressed by investors in the recognition and disclosure of asset retirement obligations. And many of them saw it as a top priority. It's been my experience that credit analysts treat asset retirement obligations as debt-like obligations. They would add those AROs to debt after deducting any sort of dedicated retirement fund assets or any anticipated tax benefits or salvage value that might be associated with it. And they may also make adjustments when they believe that the company's assumptions applied in the determination of the obligation are unrealistic. So there's and this has been going on for decades now. So I am surprised that now we're hearing much more about it. I do see some of the underlining reasons that they've expressed in the comment letters. They clearly have at least two concerns. One is the potential of the off-balance sheet liabilities not being recognized on the balance sheet. And the investors would like guidance issued that would clarify the circumstances when the designation of indeterminate asset lives should be used, and disclosures that outline the rationale for that determination and clear acknowledgement of the existence of unrecognized asset retirement obligations. And a second concern that the investors have expressed is that for those AROs that are recognized on the balance sheet, well, they want to understand the key assumptions and the underlying factors that were used in the determination of the liability because they believe there's insufficient transparency. So I do think this is a very important area, as Fred has mentioned, that analysts are currently challenged with and are foreseeing that there could potentially be off-balance sheet liability exposure that they are not able to analytically understand clearly. Another area which Fred also mentioned, risk management and hedge accounting. I think that area is very important. Preparers want to align hedge accounting financial outcomes more closely with how they manage their risk practices. Investors could certainly benefit from more relevant financial statements that better depict the economics of the hedging practices. So I do think we should address the stakeholder concerns here, research whether a holistic approach might be appropriate, such as stakeholders have suggested. Is it an entity-wide approach? Is it a dynamic risk management model approach? Is it a principle-based framework approach? Or is there a macro hedging model that might make sense? I recognize that there were some suggestions regarding targeted improvements that could be made. And it seems like those suggestions hinged on just having revisions to the pillars of hedge accounting, primarily because they don't want to disrupt the existing hedge accounting practices. But I do think that that may not provide meaningful change, notably for banks who are in the business of managing risks. I agree with Fred on distinguishing liabilities from equity. I think that's another area we should prioritize. It has been noted as a top priority. There's concerns regarding the guidance in a number of areas. And so I think that there could be an opportunity where we avoid unclear distinctions between liabilities from equity that could distort an analyst's debt to equity ratio analysis. I mean, this could actually affect how analysts think about the credit risk within an organization. So, I think we could conduct research and determine whether or not targeted improvements, perhaps to the guidance, are most appropriate. And then I'll just close out with KPIs. KPIs, it's listed as one of the top priorities for investors. However, there was no agreement as to how to address the problem. And I think that is partly because they generally were responding to the two potential approaches within the document. But some investors did comment on what I view is the fundamental problem. And I think there is a disclosure and presentation issue. And I did mention this in our board meeting on KPIs. And just to kind of summarize the points, in regard to disclosure, investors have expressed that they need to understand the adjustments that management makes when management aims to align the company's reported financial information with management's view of the underlying economics. And that's an adjustment in order to derive one of their KPIs. And another reason, of course, is adjustments to derive continuing or core earnings in their KPIs. So in my view, again, to address the problem, I think that management could provide in the notes to the financial statements the financial amounts that management views are core or non-core, non-recurring items, or items within the financial statements that management identifies as distorting risk management activities, or items that may alter the economic view of the accounting results in the financial statements. And I also think that when that is done, what's additive is that they can disclose the nature and the amount of those individual elements, connect that to the financial statement line items where those adjusted amounts are reflected, and provide period to period changes regarding the adjusted information. And that's going to inform trend analysis. And that's going to provide new insight to investors so that they can evaluate the adjustments to derive the KPIs. And that's beyond the information that investors are receiving today. And I think this research would be quite valuable. And as it relates to presentation, well, I mentioned it's, in my view, largely concentrated in the statement of cash flows, as I mentioned earlier. Thank you.
Great. Thanks, Joyce. So,
Thanks, Rich. Maybe much like everyone else, I just want to acknowledge the just monumental work that you all have done in sort of pulling this all together, as well as the outreach, those that participated in the outreach prior to the ITC and after the ITC, and also those advisory committees and councils that we talked to, some of them on numerous occasions, about what their ideas were. So thanks to all of those that really have helped to shape where we are today. I think, as I think about this feedback, and I appreciate your comments at the beginning about how we intend to bring everything back. And so we'll have an opportunity to really sort of have input directly on each of these projects, because there's just no way we could touch everything in this short amount of time. So, I think maybe just a couple of observations. Some of the areas that I have of interest directly correlate with the sort of chart that you have that shows the interest and priorities, if you will. In particular, I'll just rattle off a few: liabilities and equity, very interested in indexation. Haven't wavered from that from when we originally talked about the project. Hedge accounting, in terms of, I'm very interested in a comprehensive project, and we've talked about that in previous meetings, but I'd also like to understand maybe the pros and cons of continuing some of the other things that we were looking at. So for example, is a phased approach something that we should pursue? And I'm thinking specifically about PLM for liabilities, because we had talked about that at some point. Digital assets, I think we've done a lot of good work there, but I think, stable coins, obviously something that keeps coming up. And then some things that came up in the last project that we didn't address, like wrap tokens and other things. So that I think that we would look at. Consolidations, I like this topic. For myself, I'm probably more interested in looking at this in a more targeted way. Particularly some of the feedback that we got about the structuring opportunities that are prevalent in the related party tiebreak, as well as is there a way that we can make the analysis of whether an entity is a VIE easier? When I used to look at this area in practice, it always seemed to me we were doing the consolidation analysis at the time we were actually doing the VIE analysis to understand whether that was the case. So equity method investments, I think that's a good topic. I do think we should leverage some of the work we've done previously on this topic. We certainly did a lot back earlier before we dropped it. So I think to understand maybe what's incremental and what the challenges were at that time, that where the solution wasn't necessarily considered operable or acceptable, would be useful. And then on the statement of cash flow, I'm really interested in maybe some supplemental disclosures around free cash flow. I don't think we have to mandate how we do it, just disclose how you've calculated it, perhaps, or as well as some incremental disaggregation. And then maybe just a comment on the definition of a public business entity. To me, I would just focus on considering the exclusion of conduit bond obligor, and maybe making it just slightly more targeted of an improvement instead of, a broad-based project to look at every areas in the codification where we use private company, maybe the differing disclosures. I would do that on a topic by topic basis. As it relates to disclosures, certainly the agenda consultation respondents indicated high interest in enhanced disclosures and high interest in, getting rid of outdated disclosures. To me, it's very difficult to do one project that just looks at that. I think, in a lot of instances, the feedback that we got sort of focused on some of the other projects that were working, that were suggested as high priority. And so I would look at the relevance of disclosures as it relates to an individual topic. I think sort of doing one disclosure effectiveness project is really difficult. I think, considering the discussions we've had recently and over time about removing disclosures is always a challenge. There's always somebody that's using the disclosure, so it makes it more challenging. So I think if you look at it associated with the individual topic, it's much easier to say and look at what's relevant. What are you using? What are you not using? Kind of thing. So, and then maybe just lastly, I know the focus today is on the agenda consultation, but I don't want to lose sight of also prioritizing some of the other feedback that we've gotten on, say, like, for example, PIR, and what potential improvements could come out of that might benefit the system as a whole. And I know that's not really part of the agenda consultation, but as we think about sort of prioritizing our agenda, I think that's something that we shouldn't lose sight of. And then just leveraging wherever possible. Goodwill is a perfect example of a lot of work has been done over the years on the subsequent accounting for goodwill, and just making sure that we can leverage as much of that as possible, so that we can, again, look at what wasn't operable, why did we drop the project, why did we, things like that, to make sure that some of the incremental research can be more focused and targeted to where we need to learn more.
Thanks, Sue. And I think that's probably a good reminder for our audience that well, we've done this agenda outreach. This is not the sole way we're going to be adding projects to our agenda over the next few years. We're going to have items that come in through normal agenda requests, get referred to us from the PCC, for example. There might be items that we just as a board decide we're seeing out in the marketplace that we really need to update standard setting for or address through standard setting. So I view this as an initiative to pull our stakeholders in beyond our normal process as opposed to one exclusive of the other. So I think that's a great reminder. So Christine.
Well, good morning, everybody. There's been so many great suggestions already for things for the board to think about. And I too would also like to thank our stakeholders and the staff. I know they worked really hard. I know that you all have worked really hard. And you did a great job of summarizing the feedback that we received. So I'll just add my 2 cents, much of which overlaps with other topics that have already been raised by my fellow board members. The lens that I took in thinking about the priorities that our stakeholders had and where I think the board could have the greatest impact for investors was really identifying those topics where financial reporting today is out of step with the economics of the cash flows that are generated by various activities. And so one example of that is physical commodities and the accounting for physical commodities and the measurement of those using a costless impairment model when those physical commodities are held for trading purposes. Clearly, when you're holding gold or platinum or whatever it might be, for trading purposes, you're generating market participant cash flows through exchange, and cost is not particularly informative about those cash flows. So I think that there's something that we could do there on a measurement front. Another topic that I think we've heard repeatedly from investors over many years needs to be addressed is the statement of cash flows. We don't have a clear purpose for that statement within the package of statements that we provide. And I think that we need to understand what that statement is supposed to be adding to the information set for investors. And I think that the statement of cash flows is an interesting beast because it has cash flows that pertain to items that create income, but it also has within it cash flows that have nothing to do with transactions that create income. And right now, those cash flows are commingled across operating, investing, and financing activities in a way that makes it very difficult for investors to get a clean estimate of free cash flow, which is, in theory, a metric that is supposed to be akin to cash basis income. So I think that there's a lot of room for improvement there that would also help with investors' needs for sort of more common starting points for some of the KPIs that they're interested in. I also would agree with Joyce that while I'm not in favor of mandating KPIs, I do think that there is the possibility for providing incremental information to investors around the adjustments that companies make to GAAP measures to come up with their non-GAAP measures. And I think she did a great job of sort of nailing what that information would be in a disclosure project. Why did you make these adjustments? You know, what was your rationale for the adjustment? How does the adjustment amount map to the numbers that are reflected in the financial statements? And why did you make an adjustment one year but not make it the next year? So helping investors to understand how those adjustments change over time. So I think that that's another area that could be very impactful for investors. I also think that asset retirement obligations is an area to look at, both from a measurement and recognition perspective, because I don't think that the measurement at fair value today reflects the cash flows that many companies incur in satisfying those obligations with internal resources. And as a result, I don't think the measurement is providing very good information to investors that are trying to forecast those cash flows. And I also think that there's room for improvement in disclosure there as well. On excuse me, on aligning asset acquisitions and business combinations, personally think that's a very bad idea because the economics of an asset acquisition and what is paid to acquire an asset versus acquire a business, completely different. If the economics are different, the accounting should not look the same. That's uniformity, not comparability. But there is one place where I think that we could make an improvement for investors, and that would be in the acquisition of IP R&D in an asset acquisition. I think if we were to apply our recognition and measurement principles to that transaction, we would find that the accounting currently is not correct. So I think that is an area that we could consider. On liabilities and equity, I think that this is a particularly problematic area. No surprise there. Everybody would say that. And I think that we need to go back to basic mathematics. You can't take two buckets. So we have a liability bucket and we have an equity bucket. And you cannot cleanly separate things into two buckets using more than one characteristic. It is just impossible. So I think that the board needs to decide what horse they want to ride and just ride that horse. And I would agree with Sue. I think it's indexation is actually the economic characteristic that distinguishes a liability from an equity. So settlement and, form and timing of settlement, very important information. But I think the board should seriously consider whether that information can better be conveyed through presentation, bucketing types of claims within the liabilities and the equity section, additional disclosure to help investors understand the form and timing of settlement, but that the characteristic that puts you in a bucket should just be indexation. I think that would go a long way to cleaning up a lot of the problems that we have in the liability and equity space. And I also think that that might help with the alternative funding arrangements, because I think what we would find is if you use an indexation only characteristic to consider the classification of some alternative funding arrangements, that it might actually push them into equity classification instead of liability. But that would be something that would be, research would need to be done on that. On hedge accounting, I think that the underlying theory for our current hedge accounting model is off base. I think we've tried to fix it in a way to allow the accounting to better reflect the economics of hedge transactions. I think we've pretty much pushed that as far as we can, except for maybe portfolio layer method, PLM, for liabilities. I think that's something that we could address without breaking too badly the current pillars. But I do think that there needs to be a holistic relook at the hedge accounting model. And I think that this is an area where, along with PLM for liabilities, which I would prioritize while that more holistic project is being undertaken, I would also prioritize the disclosures and the effectiveness of the disclosures and looking at that now rather than waiting until later. Let's see. One other one that I had on my list was the definition of public entity. I think just in our NAC meeting again yesterday, we heard loud and clear from not-for-profits that are under a lot of strain right now. Anything that we could do to help that community, I think we should be doing it as soon as possible. And I think one thing that we could do that would really help that community would be to reconsider the definition of a public entity to exclude conduit bond obligors. And I thought our NAC stakeholders did a really nice job of explaining in that public meeting just how problematic it is being included within that definition of public entity when they go for debt. And then finally, while I'm open-minded to many projects, I guess the one I really would put as an incredibly low priority on my list would be Goodwill. We went through many, many years of trying to address the issues with Goodwill. And in the feedback that we got from stakeholders, and I think many stakeholders also said this was a low priority, they said, look, nobody's views on this has changed. People who think that amortization is the right model still think amortization is the right model. That's the feedback we're going to get from them. People who think impairment is the right model still think impairment is the right model. And that's the feedback that we're going to get from them. The only sort of consensus that we ever got from investors when we did the project way back when was that they absolutely do not want expensing on day one or day two, because that completely just destroys their ability to predict future cash flows. It inflates the return on asset calculation by understating the denominator and overstating the numerator, because you don't have the cost of the acquisition going through the calculation of income in a reasonable way. So impairment isn't going to get consensus, amortization isn't going to get consensus, and expensing on day one would be very detrimental to investors. So I just don't see that there's any feasible path forward. And as a result, that is not something that I think the board should frankly be wasting its time looking at. So I think that was everything I had.
Great. Thanks, Christine. Hillary.
Again, I do want to thank all of our stakeholders who provided very detailed feedback and very detailed proposed solutions, which I think was really helpful when taking in the feedback here, and want to thank our staff for being able to digest that and put that in. It was a long memo, but it was a fantastic long memo that summarized it all. But certainly when I kind of looked at the feedback in its totality, I certainly have a lot of views on all of the different issues that were brought up in the ITC, and agree with some of the views expressed by board members today at the table and don't agree with other ones, but we're going to have a great time being able to debate those on an individual topic by topic basis. But certainly what I saw was really high quality feedback that came in from our stakeholders. And I fully believe that the quality of the output that we have is really dependent on the quality of the input that we're getting. So I think we have a great start for really being able to repopulate our agenda. Certainly the topics that were identified in this invitation to comment were less concentrated in certain themes than we saw in the 2021 agenda consultation. I think even just knowing that is informative, right, for thinking about the types of projects that we would add to our agenda and thinking about the different priorities of our stakeholders. And we've heard feedback from, I think, all of the board members today on priorities from an investor perspective or priorities from a preparer or a practitioner standpoint. I think one thing I just wanted to, talk about is I think it's really important that we have room on our agenda for all of those types of projects, right? So I think it's really important when we're thinking about these to ensure that all of the feedback that's coming in, we're ensuring that we're able to address the areas of priority from across all of our different stakeholder groups. Certainly one other item is there was a lot of discussion about targeted improvements, right? We got a lot of suggestions for targeted improvements. One thing, at least when I hear the term targeted improvements, I think it can imply more of a minor improvement, or maybe it only impacts a small number of entities. I really think a lot of the targeted improvements that were suggested in the ITC have really broad, significant improvements to financial reporting, right? So I think that it's really important, and I've heard from our stakeholders of, is the board only looking to do small projects, or are you thinking about bigger projects? I think we're open to all, and I think the feedback that we got, even with those targeted improvements, could have really significant impacts in financial reporting. I think of that especially when we think of like hedge accounting, and certainly agree with board member comments here today with regards to the importance of addressing that topic. Certainly from distinguishing liabilities and equity, I think that's absolutely an important area for us to address and for us to be able to make progress on, right? And I have a lot of, I'd say, hope, because we got feedback through the agenda consultation process that maybe folks were willing to take a little bit of a broader look at that than they have in the past, right? And I do think part of what we need to think about, especially in like hedge accounting and distinguishing liabilities from equity, is when that guidance was originally put in place, was there more of an anti-abuse lens put in place at the time? Is that still fit for purpose in the marketplace today? Is that actually providing decision useful information to investors? Or are there other ways that we could look at it? Certainly agree on distinguishing liabilities from equity, a focus on really focusing on indexation. I personally have a real struggle when something, when you have a feature in an arrangement that drives a result of being accounted for as a liability, even though it has a very remote, if any, possibility of ever occurring. Not sure how important that is from an investor perspective to change the classification. But certainly, I think that those are areas where it's important for us to be able to re-look at when that guidance was put in place and is it still fit for purpose. I agree with Sue, though, with regards to when the staff is thinking about bringing these back and bringing back the feedback, phased approaches, right? When we think about taking on a project, it may not be one project. It could be a more narrow project to address some practice issues that are occurring today. It could be a broader perspective to think about how those changes, because we all know these changes aren't just going to impact one small bit of the model, they impact other parts of the model, right? I think about liabilities and equity. If you start addressing that, you also have questions with regards to earnings per share and other areas of the guidance. I think that it's important that we kind of make sure we have a holistic lens when we're thinking about the type of project that we want to add to the agenda as well. Certainly, I think it's an opportunity for us to take a look at areas we maybe haven't looked at in a while. Equity method of accounting, I think, is a good one. And not only just from the standpoint of figuring out whether that's going to continue to be required or whether there would be options for folks to move off of that, but also if there is an option to move off of the equity method and apply a measurement alternative, for example, really looking at whether that measurement alternative, which was put in place, I believe, in 2016, whether that's still operational and working as effectively as we think it should be, right? And so I think it's worthwhile to say not only re-looking at existing guidance, but also the operationality of other areas of the guidance that could be impacted by some of our proposed solutions. I also think when we think about the type of projects that would come back to the board, it's important to realize we have the board. We also have the Emerging Issues Task Force. We also have the PCC, right? So we have a number of different ways for these priorities to be addressed. And I think it will be really important for the board to consider whether there are opportunities for us to have some of our other really talented groups helping us to figure out what those solutions are to make sure that we can address the feedback as timely and effective as possible. Certainly, I think that there are other areas, and I won't go through all of the areas. It would not be a surprise that I'm very interested in hedge accounting and distinguishing liabilities from equity and in consolidations, right? I'm interested even in the areas where I think we've had challenges in the past of finding a path forward. I think over the course of the last 5 years, we've seen where we've been able to take projects that we didn't think we had paths forward in the past. I'm thinking of, our DICE project, our income tax disclosure project, government grants, and we were able to find paths forward, right, and provide decision useful information to investors. So I certainly am not scared of taking on some of those topics that we maybe haven't been successful in the past and seeing if we have opportunities to be able to make improvements there. So I will keep some of my more targeted comments for future meetings.
Well, terrific. Well, tough act to follow here after, if you've shared your perspectives, but maybe I'll take it in a little different direction. I think actually one of the most important things we do as a standard setter is listen. And one of the reasons that I really like the Agenda Outreach Project is because that's what we do. We listen to our stakeholders. But we don't set standards based upon polling. We set standards based upon what a majority of this board determines we should do to best fulfill our mission. And I'd come back to our mission, which is solely financial and accounting and reporting for capital allocation purposes, period. That's it. And that's what we're focused on, and that's what we'll be doing. At this point in the meeting, anybody listening is probably like, wow, I heard my issue mentioned by one, but I didn't hear it mentioned by any other, or I heard somebody else say something that wanted to go in a direction that I really don't want to go in, but nobody rebutted it. I'd say, don't worry. I think this is simply some initial reactions that some had to some of the 72 issues. It's not necessarily the views of the board at this point in time. We'll make those at a future board meeting. One of the other things though, that I find particularly important for us to be successful as a standard setter is when we do decide to add a project to the board's technical agenda, making sure that we know what the issue is and we have some idea how we would solve it. Because we might all think the best thing we can work on is Project X, but if we have 7 different views of how to solve it, that tends to be the recipe for the very long-term, never completed projects that we could add to our agenda. So I look forward to those discussions as we go through each of these 72 items and decide what is the actual issue that we think is there or not, and what does a majority of our board think they want to solve. The other thing I think it's important to keep in mind as we scope these projects, as large, small, is are we really fixing the issue? And are we following what we think best serves the information for the capital markets, or is it our personal preferences? And I think we'll all come back to what's best for the capital markets. So again, I want to thank the team, thank all of our stakeholders, thank my board members for sharing some views. And I think we will have a very interesting next several months into 2026 as we bring each of these items back to our board. So with that concludes today's meeting. Thanks, everyone.